Early strategies that we saw with the program was jumping in and jumping out. I'll do a little, then I'll wait a little, maybe I'll come back and try some more. And I've seen that happen on the crop side. You know, we have a disaster and boy, people come in, they want protection. About 3 years later, they say, gee, I had a loss. So they drop out, and then about the next year or two, they have a big loss. So then they come back again for a little while and get out. You know what they get? The privilege of paying premium and having the tax deduction. Because the in and out doesn't work in risk management. That pattern has really changed though in the last 20 years. More people, when they look at a risk management tool, they evaluate it, and if it's right for them, they kind of pick a plan. You can vary within the plan, but always have protection in place. That's the one that works the best for most people. So jumping in and out. Some selected certain monthly periods to enroll. Some bought a fixed percentage of their production each month. Some insured systematically by varying the deductible. They stayed with the program, but hey, I have more confidence in those months, so each period I can reset the deductible. We asked the Center for Dairy Excellence to go back, apply the program retroactively, and see what kind of performance it would have had. They went back, started February 2000, and tracked the information and applied the current program for a 10-year period. So basically from 2000 to 2010. If I can liken this row of numbers to the months that you have a choice to enroll, that's what the number in the block means. So if you enroll out here, you waited a month, and then you had 10 months that you could enroll if you chose to. And we did that each month that opportunity is there. So looking at it strategy-wise, we took that 10-month period and said, okay, if I had picked a fixed amount of milk and enrolled that each month of each enrollment period for 10 years, how would have that performed? Premiums versus loss payments. So that would be looking at the full 10 months. We took another snapshot, the calculation of enrolling months 4, 5, and 6 across that 10-year period. Another with 7, 8, 9, and 10 across that period. We actually looked at a couple different deductibles in that analysis, and the numbers looked like this. The first scenario, which was the middle months 4, 5, and 6 over the 10 years prior, with taking whatever amount of milk we were going to enroll and dividing it across those 3 months, 4, 5, and 6. The second scenario was 7, 8, 9, and 10, and whatever pounds of milk we were going to use for the whole test, spreading it over those 4 months, meaning a quarter of that amount would have been put in those last 4 months each time. And the other was to put the same fixed amount of milk across a 10-month period, putting 10% of it in each of the months, each enrollment period. There were periods in there that were over 2 years long when a payment wouldn't have been made. Prices were above the guarantee. You still had responsibility to pay the premium. And then there were other periods that we saw kind of mirrored since 08 and early 09. But this scenario with a zero deductible returned $1.33 for each dollar premium paid. Using this pattern at the zero deductible returned $1.40. And this enrollment pattern returned $1.50. Like I say, there's periods where you were writing checks for a while, but then when the market downturned, you got your money back. We did the same thing with the $1.50 deductible. Now keep in mind, when we talked earlier, we said that the dollar deductible might cost around 75 cents to $1 per hundredweight per month. The $1.50, 15, 20 cents. So here you would have got, the producer had followed these same patterns, but at the $1.50 would have got $3.26 return for each dollar, but keep in mind that's a 25-cent dollar or something like that. Okay? So you're dealing with smaller dollars, but the returns as a percentage of the dollars that you paid. And you can see how that would have calculated out using the different scenarios. The all months, spreading across all months, was a pretty positive performer in both of those. And keep in mind, that was kind of the airtight safety net, because if things went crazy anywhere along, you had some protection. Doing the same scenario from August 08 to June 09, and here are the results. And for the $0 deductible and the $1.50 deductible. Does that tell us what it's going to do for the next 10 months? No, but that was a snapshot, historical snapshot. Keep in mind that there's times when the guarantee is going to be more than the actual. There's times when the actual is going to be above the guarantee. But again, when you average it across the whole enrollment period, had I enrolled across, that would have been much different than had I enrolled just there. But you had risk management protection.